What is going on, traders? On the heels of a strong labor market, as the unemployment numbers just came out today, and the unemployment rate shows that we are at 3.6%, staying level since last month, the economy isn't exactly acting like it's on the verge of a recession if you're just going by this metric alone. However, that is not the crux of this video. There's still a good chance that we will be in a recession, since all that needs to happen is for the GDP to come in at 0% or slightly below on July 28th when the Q2 GDP numbers are released. And according to one of the major Fed trackers, we are already in a recession, and the chance that we see a contracted GDP for Q2 is still really high. But the point of this video is to reiterate why recessions are actually perfect buying opportunities and to get away from the typical doom and gloom themes that are presented, especially in this market environment. See, the indicators that are used to determine a recession are lagging. So by the time we are in one, most of the negative catalysts have already happened. In the rare case of a deep recession, such was the case in 2008, the negative effects can obviously last a little longer. To see how effective buying during a recession is, we're going to look at some data sets and examples that showcase this. Also, obviously, we will be sending out our buy alerts in the Traveling Trader Academy, just like we did with our cash secured puts. Perfect time to sell cash secured puts, by the way, on blue chips if you are contemplating that. We are also releasing our day trading course next week as of the time of this recording, which will be available to all new Academy members. If you don't know what the Traveling Trader Academy is, it's an all-encompassing platform where you get access to the alerts, the analysis, the chats, the options day trade watch list, the coaches corner, the beginner section, the Zoom calls with me, and you get access to all courses current and future, including the popular options course, as well as the day trading course upcoming. If you are interested in that, click the link in the description below and apply with one of our ambassadors. Okay, so why is buying during a recession a perfect opportunity? Let's take a look at a few data sets and examples. Let's take a look at a chart of something called the Recession Buy Indicator. This was created by a gentleman named Norman Fosback, who was the former head of the Institute for Economic Research. Using the RBI, going over a total of 30 recessions since 1870, you could see here that buying during a recession, your gains are doubled when compared to the average of all periods since 1871. Now, for those of you that are saying 1870 seems like a long time ago, how do we know that the economic factors and the stock market factors that were present then are also present now? How do we know that they're still relevant? Well, if you look at this indicator and just focus on more recent decades, the numbers are even more impressive. So the periods going all the way back to 1870 quite dilute the gains that you would see if you were only to focus on recent decades. And the conclusion that Fosback came up with all the way back in 2008 was basically, if you are in a recession, you buy the stock market. The next set of data comes from Wells Fargo and Bloomberg, and it went through all 11 bear markets going back to World War II. And the data that it found was astounding. Yes, when the economy hits official recession status, the bear market usually lasts longer. The average bear market length without a recession is actually only 6 months. When a recession is included, the average bear market lasts 20 months. However, that longer waiting period does not come without a reward. The average return 12 months after a bear market ends is 29%. However, if that bear market included a recession, after that bear market ended, your average returns are almost 50%. And you might be even more surprised to find out how markets actually perform during a recession. The S&P 500 surprisingly rose an average of 1% during all recessionary periods since World War II. As we stated before, that's because the markets usually top out before the beginning of the recessions and find a bottom before their conclusions. So most of the recessionary indicators are lagging. You throw in the fact that the stock market is also forward-looking, that means that for stocks, the worst is over before it is actually for the rest of the economy. As a matter of fact, in almost every single recessionary case, the S&P 500 has bottomed out roughly 4 months before the end of a recession. Now, of course, it must be said that recessions are not fun for most people, especially if you are gainfully employed or you run your own business. However, if we're just isolating it to what goes on with the stock market and all you're interested in is stock market investing, well, recessions historically are the absolute greatest times to invest. And if you're scared of what's to come in the stock market, yes, the bottoming out process could be ugly, especially in an extended recession, but just know in the back of your mind that recessions are the point at which you want to buy if you want to make life-changing money for the next 10 to 20 years. And that's not me saying that, I'm just going off of the data. I cannot stress enough the importance of setting expectations realistically. So I know that in the interim, it feels like shit if you bought in 2021 and in 2022, your portfolio looks down. But if you are investing and not trading, remember those are two different sports. As long as you invest in quality companies and indices, which would likely put your portfolio at a 0.5 Sharpe ratio or better, then over 10 years, you are almost 95% more likely to beat out just sitting in cash. And that is any given 10-year period, whether we're talking about a bear market, bull market, recession, or not. And lastly, we must talk about how the Fed might behave during a recession, because right now, all the Fed is doing is trying to fight price instability because prices are sky high. However, if we take a look at the price of commodities, besides oil, which continues to teeter, it has dropped, but it continues to teeter in a range. Economic data shows signs of cooling costs for companies, and it shows signs that prices of commodities are actually dropping. The next CPI report will be July 13th, and if it comes in below 8.6% year over year, then that will give the markets confidence that, hey, maybe inflation is cooling, so the inflation story might be priced in. We got the unemployment numbers today, and it beat expectations. And conveniently, the next GDP estimate for Q2 is going to be July 28th. And this comes after the FOMC meeting on July 27th. So the Fed will act before the next GDP numbers are released. This will likely be the last time that the Fed can actually do a 75 basis point rate hike if we are actually to fall into a recession come July 28th. Actually, we wouldn't fall into a recession. We would just know that we are currently in one, which is why if you look at the FOMC watch tool, the likelihood that we will get a 75 basis point rate hike is at 93%. Actually, the likelihood we'll get a 50 to 75 basis point rate hike, but most people know that we are going to get a 75 basis point rate hike. However, if you look at September, the likelihood that we're going to get a 25 to 50 basis point rate hike is the highest one at the moment. And that is because the markets are bracing for the potential of a recession. And how will the Fed act if we actually do get a recession come September, which is the next meeting? Well, at that point, if inflation looks like it's slowing down, the Fed will be more worried about how aggressive it is getting during a slowing economy. We might even get a pause in rate hikes or a very small rate hike compared to the 75 basis point that we recently got. And according to Michael Burry, it is ironically possible for the Fed to even think of easing again towards the end of the year if we do get a recession, and it is wreaking havoc on the demand of goods and services. Anyway, traders, that is it for this video. If you got anything out of this video, leave it a big fat thumbs up. Let me know what you think in the comment section below. Are we going to be in a recession come July 28th? Are we going to avoid a recession? Are you guys investing now? Are you guys waiting? I love to hear from you. I try to respond to each and every comment. If you want to apply to the Traveling Trader Academy, where you get access to all the courses, the Zoom calls, the chats, the alerts, everything all encompassing, that link is in the description below. So click that and make an appointment with one of our ambassadors. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.